question, Peter. Do you sit tight through a potential shooting star candle when the level is violated or get out immediately? Well, like I said, if the dealer extends the high, I want to see what he does in 15 to 30 minutes, right? So if let's say I take a railroad track and the dealer hangs at the level, actually, thinking about that, you wouldn't even be in yet. If the dealer vectored straight up, right, and he starts holding the level, you don't have anything yet. You don't have anything until he pulls back. So understanding what's going on with those candles, if he vectors to the outside, right, if the dealer vectors, all right, you guys got to watch you. I already see you're taking shit that hasn't even set up. All right, look. If the dealer, grab my pen. If, let's just say you're in here, right, and the dealer goes straight up, and he's here, and he's issuing a shooting star, right, you don't have anything yet, okay? If you got short right here, shame on you. You don't have anything. Okay, so you're waiting to see what he does. You don't have anything till he falls off of the number. Right? Remember the numbers. I don't care about this structure. I care about the numbers. He established at 6184 by 86. He held the level, opened the spread, comes back, starts to fade away. Now if I want to wait for a confirmed entry through here. Now, if you got a first leg, pull back, second leg, shooting star. Okay, depending on where the shooting star falls, yes, absolutely hang tight for at least 15 minutes. Wait and see what he does. He needs to come back below in 30 to 45 minutes. So if you took this entry here and this structure was slightly above, you got to wait till him to come back below within 30 to 45 minutes. If he comes back below, this trade is still good. You're still hot, okay? Yeah, I won't say your name, but someone wrote, I used to short the first leg. It does not work. It doesn't work. You have to wait until the dealer shows you something. That's why by the numbers, it might make more sense why you don't short the first leg, because by the numbers, you don't have anything. This number at the top of this run is not a lock until the dealer does this. And he does that by moving the number from 84 to 62, back to 78, and then corrects off of that. That's understanding that should help give you a little more understanding of what you're looking at when you're staring at the candles. A vector candle straight up or straight down is not a trade. What if he creeps up after hitting the high and pulling back? Okay, he'll creep up, but does he break the high? It's not a matter of him creeping up. And yes, they are creeps. It's a good way to explain it. What if he creeps up? No, what if he's just a creep? Okay, if he hits the high, right? And then you're saying he goes down and he starts drifting back this way. Okay, the trade is good unless he breaks this number. If this number changes on the board, the trade is, then you got to analyze the trade. Does he close above and hold above for 30 to 45 minutes? If he holds above for 30 to 45 minutes, it means you got 3 closes above. He's going to rise. Okay? What do you do if they just start to roll over? That's where the half a Batman comes in, and you'll recognize those. All right, Alan, the thing is about these, man, is that the best way to stake a lot of lots on a position, unless you know the direction, is second leg formations. I've been saying that since you met me, I'm pretty sure. Yep, I have. Thank you for confirming that. And I know you're doing really well on busting your balls, or chops rather, excuse me. Forgot we were in public for a second. All right. Okay, here we go. Yes, Gloria, railroad tracks are good. I'll cover it. When trap volume is not met, the market maker has 2 moves left. Hit the stops and rise. Hit the stops or fall, depending on what part of the segment they're in. So I've been drawing M's. Let's do a W. Okay, so here's what I was talking about. Got ahead of myself on the slide. If the dealer hits the low, comes near it, doesn't take it out, he looks at his book, doesn't have what he needs. He's only got 2 moves left. Hit the stops up and continue to fall, right? Or hold the level and handle the crosspair that's comprised of this major that he's working. So if this is Euro USD, and he was seeking a number that was not given to him from the marketplace, he can hold the level, and he could move EJ, he could move Euro odd, Euro CAD, Euro GBP. Any euro-based pair can be moved by holding euro and working the other cross, yen, Australian, pound, euro GBP. He can work the cross or notional by holding the base steady, right? It creates a disparity in the fraction. Okay? Now what's going to happen? He can hold this level into the next day, and then you expect him to hit the stops and rise. If he holds the level all night into the next session, then you look for the stop hunt to come in around the same level and rise. Okay? Understand the entire business is about the high and the low, how the dealer handles the high of the day, the high of the week, the high of the quarter, the season, the year. It's all about the highs and the lows. Because what is he doing at those numbers? He's picking up money. So if it's about the money, and that's what it's always been about, it's how he behaves at where the money is trapped. That's what you have to understand. Okay, so this is the biggest factor in this that is part of the human condition that messes with people. The moves are carried out over a time interval and induce traders to take a position. He doesn't care that you got to leave for work at 9:30. He could care less that it's getting late and you're tired and you still need to give a kid a bath and put him down. He could care less. So what he'll do is he'll show you something and drag it out for 2, 4, 6 hours into the next day, into the next session. And you're sitting there going, come on, I need a short euro, I need a short euro, I need a short euro. No, he doesn't care. It's one dude works for 8 hours and turns it over to the next dude who works for 8 hours and turns it over to the next dude who works for 8 hours. They got it covered. You have the human condition. You can't sit there for 24 hours. You'll die. Most of you try, and some of you have died. But this stuff will make you sick. You can't drink Red Bull, sit there stinking up the joint, and just think you're going to outwit the dealer by sitting there. That's not how this game is won. They use time against us because we suffer from the human condition. We need sleep. We have families. We need to have some kind of life outside of the business. So that's one of their weapons against you is the time element. That's why understanding what I'm talking about, that you trade the first few hours of the session, the end of the U.S. session going in, end of the London session going to the U.S. session, those couple of windows of opportunity where the dealer will lay out these setups. And if he doesn't, he doesn't. Okay, someone said that you need either that or a good coffee maker. Yes, that's true too. But putting more time in front of the screen is not going to make you better. It's going to make you more tired. Understand that you can go back and do homework, R&D, and understand these setups and break them down and make your flashcards. And having those items in your hand and studying those are going to make you proficient when the dealer presents what you're talking about, what I'm talking about. That's what's going to make you a better trader. Not camping out for 22 hours in front of there, not leaving your office, grouchy as hell, mad at everybody, tired, exhausted. That's not going to make you a better trader. What makes you a better trader is your ability to spot these things in real time at a certain specific point of the day or the cycle. That makes you a better trader. Okay? All right. Next slide. Okay. If you get caught by the market maker or get caught up in this move, you should have scratched out. If you did not, you simply wait for the next level, rise or fall. So here's what I'm talking about. Here's how the difference between an amateur and a professional. An amateur gets stopped out, kicks the dog, starts to cry, and walks away from the screen, maybe punches a piece of drywall or something. I don't know. That's an amateur. That's someone that lets their temper get the best of them. They don't approach the market methodically and systematically. Okay? If you take this formation and it does not go into profit, okay, you either 2 hours has expired, right? You have -5 +5, you scratch out. Now you wait methodically for the dealer's next move. The dealer should rise or fall to the next level. In this example, rise to the next level. Maybe he'll go up here and do half a Batman, right? Maybe that's something he'll do. You're waiting for the next set of behaviors to give you an entry. So if you scratched out here, wait for the dealer to extend the high and then lock the high in for the day. There's always going to be a high and a low of the day. Always. That's the business. If he extends the high on you and you scratched out, great. If he extends the high on you and you stopped out, that's fine too, but look for the re-entry. The re-entry comes a minimum of 2 hours away. Why? Because I told you that the chart is comprised of hitting the stops and bursting, right? So if he does 3 more bursts in here, and he does it in a minimum of 3 candles, that's 45 minutes right there. What is the ideal setup? 90 minutes to 2 hours. So if he goes into consolidation at the new level that is formed, and he does 90 minutes, I'm no mathematician, but I think 90 minutes plus 45 minutes is 2 hours and 15 minutes. And if I'm off, let me know. It might be 2:30. I am no mathematician. That's why I said that. All right? It's about 2 hours and 15 minutes, 2.5 hours, somewhere in that range, right? So if you wait for the minimum time, remember it's a time element. The dealer's using time against you because you want to hurry up and short the euro. He could care less. He might give it over to the next session. He might re-vector out of the high and hand it over to the next dude at gap time. And then he's going to false move session beginning, 9:30, 9:45, look for the correction. So if you get jammed up late in the session, 7:30, 8 o'clock, and you get stopped out, the smart thing to do is to wait for 9:30 to look for an entry, or at least 9 o'clock for gap time for another entry. 9:30, 9:45, the dealer rises. Let's say this starts at 8 o'clock, and this goes on. You get jammed up at 8 o'clock. You decided, okay, let me clean this up. You took your trade, right, and it was 6 o'clock in the morning. Nothing panned out. It is now 8 o'clock. You scratch out. The new session comes on. The dealer makes his move. You wait. It's now 9:45. You notice that the high seems to be formed now, and then you get the U.S. reversal around 9:45, 10 a.m. And instead of having a losing day, because this would have stopped you out big, you took a -2, and you got +30 or +50 on the retrace back into the range. And then the dealer ended the day in consolidation right where you were. And if you'd have held that with no stop, which I'm not telling you to do, people do it, you would have ended up +1 or break even, and instead you ended the day +48. The difference between an amateur and a professional trader is taking this structure, realizing that the 2 hours has expired, waiting for a possible new session to come into play when the dealer comes on at 9:30 and is forced to make a new move. They don't come on because they're bored. The new guy comes on and he works. So the new guy comes on, you can expect some activity. So if it's 8:45 and you're in trouble, the trade hasn't panned, scratch out, look for the new session, changeover. New market maker, new operator comes on. He gets his new set of targets. He spikes to the high again, hits the stops. Don't trade until you hit the stops. Woo, 9:45, take it. All right? That's what I'm talking about. The difference between taking something and letting the market prove you right or wrong, and being an aggressive trader, getting in there, managing your equity, small bites, and beating these guys up. Okay, cool. All right, we are going to look at the trap candle patterns. But what I want to do is I want to pull out the most recent writings of that stuff. I haven't updated these slides yet. I'm working on that for the New York class. What do I need? I need this one. I need boot camp number 9. I showed you the individual candles. Now I want to show you how the candles comprise together. I don't know what just happened. Sorry. The candles comprised together will make up the trap moves by the dealer. Okay, so what they are is the trap candle patterns, dealer structures, and analyzing the behavior. We kind of done most of that, but analyzing how the price changes, sharp changes on the big board. The big board is the high-low board that's on your platform on the left-hand side. Some of you have it, some of you don't know how to get it. I can't remember the key pattern. I think it's Control 9 or F9. But we'll look at it before we bail, or I'll take some pictures for you guys. Okay, so trap candle patterns and the structures that the dealer makes by comprising these types of candles together. Okay, so the dealer puts together. Hold on, I need a board. Okay. F10, F10, F10. Hit F10, open up MetaTrader 4, hit F10, and the big board will pop up. Right click on the board and tick the box high-low. You know, that's a big board. That's what they use. Okay. My personal favorite, I don't really trade it, but it's pretty. Unless it's absolutely blatantly obvious. Half a Batman. Okay? What is half a Batman? By definition, half a Batman is the dealer has spiked a high or low, so it would be half a Batman or inverted half a Batman. The dealer has spiked a high or low as a means to set it for the session. The dealer is now trading off of that level and has formed an outside structure. Last night in Euro and CHF. He will not repeat the level again, or he will allow some type of profit booking by the traders. Okay, remember, a dealer has two hands. He goes up and grabs a boatload of money with one hand. Trying to get the pen color. All right, is yellow going to work on this? He goes up. Probably not. Let me get black. Hold on. All right. He goes up and grabs a handful of money. Okay, just picture. Here's his thumb. Here's his hand. I don't know, he has extra fingers, web feet. Okay? Now, if he goes back to that level, if he goes up and makes the second ear or the M formation, he's going to allow some aggregate of traders to release in here. He does not want to do that. So this structure comes in like this and never goes back towards the level. He does not repeat the level. And then price appears to just roll out of there. That is where half a Batman came from. Okay, see it? Now you can't see it with black, but I'm not changing it again. Okay, so that's the definition. All right, here's what it looks like. Vector to the high. You got me, I got to change. Vector to the high, come back, hold the level, and then roll out of there. Vector to the low, inverted half a Batman, roll out of there. Okay, without my terrible white lines on there. Spikes up. Holds the level for how long? 1, 2, 3, 4, 5, and some time off of this candle. But let's not count it. The highest established on this candle, where I come from, that's 1 hour and 15 minutes. I think it's the same time where you guys come from too. Shift the zone. Okay, notice something very telling in here. Anyone? Little blue tracer. Blue tracer is yesterday's high. The dealer has spiked above yesterday's high. He has hung above that level, which anybody trading breakouts of highs and lows is now long. And then he's like, I'm just kidding. Comes right back below. What did I tell you about the business? It's how the dealer handles the highs and lows. Today's, yesterday's, the weeks, the quarters, the seasons. Okay? He induces traders. Sets the high of the day, comes right back below it. Spikes above the high. from yesterday, doesn't come below, but works it, induces breakout traders to take. Okay, guess what? 1, 2, 3, 4. That structure right there of those 4 candles, these 4 candles right here, makes a 1 hour close above yesterday's high. Okay? It's always yesterday's high low, correct, the blue tracer. But understand that this behavior right here with price, these 4 bars right here, 4 candles, has shown on the chart a breakout, if you will, above yesterday's high on the 1 hour time frame. Why? Because I can count at least an hour that the dealer stayed above yesterday's blue tracer, yesterday's high. Anyone that trades high-low breakouts has now taken a long position. 15-minute, 30-minute chart, 1 hour chart is now committed long. On a break above, breakout traders above yesterday's high are now committed long. A trap move by the dealer. But you understand this by breaking down this segment of it right here, that the dealer has set the high, has come below that high, and has consolidated or accumulated, waiting for those people that don't know any better to do this. And then he comes right back below it. Okay? Outside structure, half a Batman. This is the outside structure, but it also is the half a Batman. He makes an aggressive move to the low, and then price floats or stays off of that low. It's like floating in the middle, but off of the low or off of the high. Okay, same thing. Variations on the theme. He hits it, he taps it, and he hits it again. Makes the ear, rolls out of there. Right? If you see this setup, just tell yourself, okay? Helen, he didn't stay above the high. He stayed above yesterday's high. He went below his high that was set. Right? Good question. Let me back up. Hold on. Put the brakes on. Right there. Did he stay above the high of the day? She said, I thought if he stays above the high for an hour, he will rise. He didn't stay above the high of the day. He hit it and came below it. Right? Okay. Are you with me or what? Still with me? Correct. It had to stay above the high of the day. The dealer will rise if he sets the high of the day and comes above it and stays above, he's going to rise. Same thing for the low, the opposite, okay? All right. The entry on a half of Batman is wait 1 hour and make sure the dealer hasn't extended the high or low anymore, and then look for an entry in here. They're not good solid entries. They're better entries when he makes the second pass. The M formation is a far better entry. Yeah, I know, Malcolm, but she wasn't sure. So I want to make sure we were clear on that, okay? The M. This is pretty cool. This is a spider web. It's a trap. All right, definition of the M. An aggressive move by the dealer to set the high of the day or the high of the session. The first leg rise induces traders to take long positions. The center, I don't know what that's called, the apex, or someone told me it was weird. The center triggers their stops and gets traders to stop and reverse short. The second leg, it was called a nadir. The second leg rise triggers those stops. The second leg rise can be slightly above the first, but must close below within 30 to 45 minutes. Right? We talked about that. So what I'm talking about is this. Pull back. When you're right here at the high, it can do one of two things. Miss it, or it can go above and come right back below. That is a valid M pattern. The move triggers the stops of the traders that have taken short positions off of the first leg, grabs any breakout traders that have pending orders waiting there. That's by our definition of what an M is. And then some pictures of some. Okay? All right, triggers the stops, pulls back. Good entry right there. All right? Look how he ends pretty on 2 hammers. Notice how he's working yesterday's numbers. This candle goes up green, turns inside out, ends on a hammer. Goes up one more time. Notice each pass doesn't take out the high, but comes near it. By the numbers. What did he do with the numbers here? Remember, by the numbers. By the numbers. By the numbers in the spread. Okay? I'm fading. No, I'm not. I feel 100%. Okay? Then you know this is coming. The dealer shifts the zone. Snatches that away. I did take a sip here. I'm good, man. I feel great today. All right. Again, this is the one where he extends the number, comes back below, right? There's the high. Happens to be right on yesterday's high. He spikes above and comes right back below. That is a valid entry right there. This hammer, the fact that he ends on that hammer, actually validates that M formation for all of us. Here's why. Since I told you the whole business is about money, and that I told you that it costs money to move the market. It costs the dealer money to move the market. They just try to move it on as little money as possible. He didn't spend whatever it cost to move this candle all the way up and all the way back because he felt like balling up hundreds and throwing them out the window. That's not what he did here. He did that behavior because he went up and grabbed whatever money was sitting there. It was more financially advantageous for him to go back above the peak or back above the high and grab what money was waiting there for him. It was like, let's say in his left hand he's got 200 million and he's looking at the number over here and he goes, okay, I understand that if I go back above this number, some amount of this 200 million will reaggregate back into the market and will let go. But if I go up there, there's 300 million sitting there. So if I make this move as a dealer and go grab this money, I'm going to definitely lock 300 million, which is 100 million more than I'm holding right now. And not everyone will click out. Maybe half will click out. Because the other half's going to think they're in profit. The other half is going to be like, I have a chance to book 2 or 3 pips, I'm getting out. So with that mentality and that understanding of the numbers, the dealer can make a move and net around 400 million on that move. So if you were a dealer and you can up your float by 200 million, would you go, maybe I shouldn't move that hammer up there? Of course you would. So by extending the high and coming back below it, there's some financial advantage for him to do that by the numbers. So by the numbers, the dealer looks at the book, analyzes what's sitting above that tracer, realizes there's a bunch of breakout traders from yesterday. I got all the people that got this short position. They got their stop sitting up there. Man, I could just go up there and have a field day and grab me another 300 million and come out with a plus 400 on the deal. I'd take that deal right now. So what does he do? He flashes price, runs up there for 15 minutes, and comes right back down. And that behavior, the spike above and close back below within 15 minutes, absolutely confirms that this is a good trade. And if you're not 100% sure, you could simply wait for the confirmation candle, which gives you the signal crossover, a close below the catch-up, to make this a confirmed formation. A good entry's here, very tight stop, 12, 13 pips. A good entry here, probably around 20 pip stop. Either one is acceptable because you're going for 50. The risk to reward takes care of itself when you learn how to deal near the high. Okay? Yes, Terry, absolutely a good point. There is no close above the first high that is set. When the dealer sets the high of the day right here, nothing closes above that high. Look at that. Okay? He comes near it, you know that his edge to work this. His edge to work this. Well, guess what? He tried to work it, and he said, the hell with it. I'm just going to beat the hell out of it. He went all the way up there and opened the spread and grabbed everything. Okay? He came back here, stopped out the traders that went long in here. He grabbed their stops in here by spiking this way. That's what's going on here. That's what people conceive as volatility or risk appetite. This is a lack. Saying those stupid things at the M and W formation is simply a lack of understanding what's really going on in the market. Now you know better. Okay? All right, so putting the M together with these candles, right? That's what this whole section was about, sorry. It's the structures that the dealer designs with the candles that I showed you, the hammers. It's part of the structure. These individual little candles make this entire structure. They bring it together. They help you understand what's going on. The hammers, the spikes become unidirectional. They become unidirectional in their behavior. They start spiking to the side that he's trapping, right? Draw the arrows of what people are thinking. They're thinking up. They're thinking up. They're thinking up. The dealer shows them up. He shows them up. When they bite, he just goes, I was just kidding with you guys. And he shifts the zone away from those traders. And this area on aggregate is trapped and in his pocket or about to be in his pocket. Okay? Beautiful example where there was no levels, but just showing you a nice M formation. Look at the pins. High, high, pins high, pins high. A nice W formation, pins to the low, bouncing off the moving average. Shark fin high, shark fin low. We'll still talk about that stuff, no worries. Okay? W formation by definition. I know Alan's getting hungry. We're okay. Okay? By definition, it's the exact opposite of the M formation. It's an aggressive move by the dealer to set the low of the day or low of the session, the LOS, LOD. The first leg correction induces traders to take the short positions. It's for the breakout guys. The center, I think that's called the apex in this. That's the only one I know. Triggers the stops and gets traders to stop and reverse long. The second leg correction triggers those stops. The second leg correction can be slightly below the first, but must close above within 30 to 45 minutes. The second leg correction will only go below the first leg if there are orders built up there. It's called the zenith. Okay, cool. I'm learning the English language. No worries, I'm only in my 40s. I think I would know this stuff. The second leg correction will go below the first if there are orders built up there in the exact picture I just showed you. Why would the dealer go up or go down there? Money. The move triggers the stops of the traders that have taken long positions off of the first leg, by definition. Okay, that's what he's doing. All right, now, you got the definition. Here's the formation. He forms a cord of wood on the low. This is a double cow, in essence. It is a W, though. Double cord of wood. Look right there, man. He just goes slightly below. There's the low. I drew the line for you. Look where the wick ends. Slightly below. And then understand his grasp is bigger. All right, here is first leg on Tuesday. He repeats the level on Wednesday, but just misses slightly above. Okay? The dealer is doing one or two things. He's either going to an area to collect the money or stopping price from hitting an area to defend against money or orders that are there that he cannot afford to put on his book that will dilute his volume. Right? So let's say the dealer goes in here and he got balanced here. Balance would be he's net long and net short in an equation that works for him. If he goes and hits this number, he wants to be net long. Let's say there's some level of volume that's down here that if he goes and grabs this number will screw up this book. He can't handle liquidity. It's too much, whatever the reason. So he literally puts the brakes on above this price point because he's defending against price drifting into that area. If price drifts into that area, he's got to make the market. The dealer's job is to make the market. Right? He has to. He's allowed to beat the crap out of everybody and be a multi-quadrillionaire, but his rules are you got to make the market. You got to take the orders. So he will defend against price drifting into the zone by putting the brakes on at the low of the day and pulling the hell out of there. Because he's defending against some block of orders that might be sitting here. His job is to gather up and defend against orders to keep his book net longs, net shorts in the right position. Always for him. That's the business. Okay? And always come out in profit on aggregate as a dealer. That's their job. All right? I said this in here. I don't even know why this picture got in here. I forgot to take it out, remember? Okay. I need to make a note. What slide number is that? 33. I got to squash that. It's in the wrong segment. That's a half a Batman slide, and it's in the M&W structure. Sorry. Okay, here's a W formation. This W is pretty cool. This W happened when I first met Kim and Casey and Dean. Like, I guess it's been 2 Decembers now. And they after they all took my class, I told no one to trade over the holiday to go on vacation, and then they sent me this. They all took it. You guys, some of you guys remember that. I don't know if Kim is listening, but she's probably laughing right now if she can hear me. All right? That's a perfect W formation. What happened? The dealer established the low, pulled back, hit the stops, induced, pulled back again, hit the stops, shifted the zone away. And I know everyone on this trade, I remember specifically everyone got plus 50. They were hanging out in the lounge back then. Okay. Star formations. We talked about them, but let's hit them again. It's a combination of railroad tracks and an extra 15 minutes grabbing money. Evening star, morning star. Simply put, it's an extra 15 minutes for the market maker to take your money. Don't let him take your money. That's all it is. Okay? Back in. Is everybody still good? I'm going to try to finish up this section before we go to dinner. Okay? Extra 15 minutes. What did he do? He broke the high and closed back below the previous high. That's still a good trade. That's why you got to give him his 15. You got to see what he does. If this candle closed green, totally different story. Okay? All right, same thing. Morningstar formation. It's simply the dealer sitting here gathering up contracts. Remember, by the numbers. It's an extra 15 minutes. All he did was take 61.30, extend it ever so slightly to maybe 26, and sit there for 15 minutes. That behavior induces people to take this behavior. Because you don't have the luxury of seeing this stuff now. You see a solid red candle sitting down there, and you think, oh, it's going down, it's going down. You take it, or traders take it. Then he closes on a pin in the last 2 minutes of the candle, then shifts the zone away from them and runs. Okay? The individual candles that build these structures or comprise these structures together is what we're talking about now. Okay? You're looking at star formations, but on the bigger picture, there's the consolidation zone. The dealer went in there, hung out, and made what he needed to make to grab the traders, okay? Outside structures. Outside structures, by definition, are the vector portion of the half of Batman. Okay, it's the vector portion. The outside structure is this. The vector portion coming out of the box, the vector portion of a half of Batman. It's used to set the high of the week or low of the week, the high of the day or low of the day. It's the single leg. Whereas the stop hunt will come at a higher or lower level. Okay, so he's at the level. Right? He spikes as the stop hunt, and then he opens somewhere off of that number. And what happens is, in essence, is he's trapped the volume here, so he pulls back and opens off of that number, 15, 20, 25 pips off of that number, and then he simply accumulates and will not make the second leg. The outside structure is this portion of the vector candle that makes the stop hunt. Here's what it looks like. Okay? There's your big, fat vector candle. He goes in there and he creates an outside structure. His structure is built outside of this accumulation phase because he went in, trapped the volume here, and now he does not want to repeat the level. This happened last night in Euro and CHF. Take a look. It was on your quiz. I promise you that this is not the last time you're going to see this outside structure high or outside structure low. It's a common practice by the dealer, and it is used to jam a lot of people up. Okay? Because what happens? You see this big red candle as a retailer, and you want to sell into that excited as hell, thinking you got it. Because look, without even looking at the rest of the chart, what's the trend? Down. Angle and separation of the averages. Pins are starting to turn to the downside. The spike to the low. Pins, 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 pins. I can go on all night. Trap to the downside. Okay? Yep. They hold price in the center of the range. Okay? Outside structure. This is very similar to last night's. This slide's a little older. Look. Extended the low. 1, 2, and then ping, he tapped it again. Remember, by the numbers. Then he comes off of that. That is a trap move all day long and twice on Sunday. All right? If you see that outside structure trading off that number, consolidating off the number, look for the reversal, man. Okay? Outside structure with an extra hammer in there. Make you feel good. See it? This segment has to form the high of the day in this example, or the low of the day in this example. This has to be the high or low of the day. And it has to be coming out at the appropriate times. Otherwise, it's not the right structure. Okay? All right. Classic outside structure. The dealer has showed angle and separation. I hate that, but that's from Forex Made Easy, right? The high is established here in the U.S. session late, right? Because here's our start of a session coming in here. Towards the end of the day, late session, he makes his last aggressive push to the high. He ends on railroad tracks. He comes near the high but fails to break it. Fails to break it. I already know this is the trap move. The dealer's trading off of yesterday's high. I expect straightaway drop out of the structure. Okay? This is level 3 behavior. Sideways movement, no market. Market's not rising. I expect him to correct back. I know the price has been rising for at least 3 days because of the distance, the way the averages are set up. The market maker comes near the high of the week but does not break it. 2 more times. The spread is widened to grab these orders. The averages start to flatten out. They start coming back together. If you notice in one candle, he hit the stops in both directions. Let me erase this so you can see it's pretty cool. The mustard in the background makes an M. You see it? Look at the mustard right there. Stops are hit in one bar. That's this right here. Both directions. And it's gone, plus 50. Okay? Intraday outside. That was a multi-day outside. Classic outside structure usually is over a couple of days. This is yesterday, and then they work the level, and then you get straight away. Straight drop out of there. Okay? And then this is intraday. Look at last night's is probably a better example than this. Last night, Euro and CHF, right? The dealer comes out, straight drop. You got a little baby W in there forming. Look at the pins to the downside trap. Pulls off into consolidation, holds the level, and then see you later. Okay? Price, if you're a retail trader, The outside structure is created by showing trend acceleration, by showing the candles going down hard and fast and pulling away from the averages. Notice how these candles aren't even in touch with the average. They're away. That, by definition, is a trend continuation move. It's considered momentum within the trend. But I promise you, the standard deviation rules and all that garbage, when candles get too far away from the averages, they have to snap back. That's standard deviation type stuff, but don't drive yourself crazy with that. The entries are on these hammers or in the consolidation zone in here. Okay? Outside structure, outside structure. Okay? Multi-day outside structure again. A big, huge vector is established. The dealer is trading off of the area. He comes in, he chops back and forth, bringing it in, bringing it in, bringing it in, analyze. This is a straight rise because he doesn't make a visible stop hunt below. But if you get the outside structure low or high trap, the dealer will rise away from this area or fall away from this area. And don't sell this and get jammed. This is for the breakout traders to mess up their afternoon. Okay? Remember I told you between 1 and 2 a.m., this box ends at 1 o'clock. 1, 2, 3, 4. He will widen the swing to handle the breakout traders. Okay? Steve, he did it at 2:20. I'm sorry, he did it 20 minutes late. They don't follow the rules, they make the rules. Okay? Just understand that this is an outside structure, and what the dealer has done, bring it in, reel in the volume, reel in the volume, reel in the volume, bring it in, bring it in, bring it in, tighten it up, punish, hit the stops, rise. Okay? And then here he stuttered, hit the stops, hit the stops. Okay. 10 more minutes, we'll go to 8:30. I'm almost done. Okay? Multi-day outside structure. This is beautiful. Okay? Here's your consolidation. He extends the low. Beautiful, hard vector to the low. That vector move used by a news trigger, and then he trades off the level into the next day. Right? We expect he pinned the blueberry in straight rise, straightaway area. Look how tight that channel is, 18 pips. He tightened it up. He tightened it down because he brings it in, brings it in, brings it in, tightens up the volume. What happens is, if you look at it from a retail perspective, is that they're expecting sell the rallies in a downtrend. So people are expecting this. So he's grabbing sellers. Look at the structure of, look how the pins have twisted. Look at the pins, all twisted to the downside. Look at the pins, big to the downside. Each one of these, trap, pull away, trap, pull away, trap, pull away, trap, pull away, bring it in, reel it away higher, shift it away from them. So he caught some amount of traders here. He caught everybody selling the rallies in a downtrend, shifted that away from them, hit some stops, bring it in, tighten it up, and he tightened the volume all the way down to where no one could see a profit. See that? He tightened it up. 18 pips. Take the spread off on both sides. What's left? 12, 13 pips? You could take 6 off of there, 3 on each side if it's pound. 2 to 3 depending on the dealer, right? So now he tightened you up into a 9 pip range. If you went long, you're not clearing the spread. If you went short, you're not clearing the spread. You're stuck. If you don't understand what his next move is based on this behavior, you're stuck, man. This vector to the low outside structure over multiple days, solid gold. It's a trap move. The dealer will give you some small area to get into the position. If he gives you a beautiful low stop hunt, you got him. Perfect. Okay? Spike candles. What's a spike? By definition, an aggressive change in price, usually following a news announcement, used to trigger the stops or move the trading zone. Look, when he wants to shift the trading zone, he'll make no bones about it. He'll simply spike it, move the price. It's like, oh, I wonder if it's going to shift up or down. Just drop it 100 pips and move it over. That's what they do. That's what they use it for. They might bury it behind non-farm payroll. They might bury it behind FOMC or whatever the reason is, but they're doing what they need to do, and that's the excuse. Oh, did you see what happened on the news today? The U.S. job numbers were abysmal, and man, did Euro take off. Garbage. Dura, that's a very good point. She noticed that the market baseline on an outside structure is at 32 or 68 and can hold the anchor even at level 2. Yes. We talk about TDI, we'll look into that. Thank you, Dura. The direction that the dealer will spike is based on the dealer's open volume, net shorts or net longs. That's it. Nothing to do with the retail trader's trend. Spike comes because he needs to take your money. Just throws it up there. You don't believe long? Let me show you a long candle, buddy. That's a long candle if I ever seen one. Well, I was just kidding around with you. Sorry. Non-farm. This looks like an uptrend. I'll show you an uptrend. Sorry, just kidding. Okay? There's one for you. Another news release. The spike is just simply a way to change the zone. Okay, railroad tracks. Well, we know what they look like here, but what are they for us, for our purposes? By definition, a 30-minute structure where the market makers triggers the stops, shifts the zone, sets the high, or sets the low on one move. Okay, good question. Spike and a vector, the same thing. Yes, more or less. The spikes are usually bigger. They're used at news releases like 100 pips. But what I talk about with the vector is usually, like if you look at non-farm this week, well, I guess they use spikes to set the high and set the low aggressively. But what I like to say is